You look at the Bitcoin chart today and think, if I had done what Michael Saylor did, I'd be rich. The part no one tells you is simple. If you try to do what Saylor did the way he did it, you'll probably blow yourself up long before you get there. The same strategy that makes this guy rich almost destroys anyone who copies it without understanding the game. Saylor is not the random guy on an exchange buying a bit of BTC on his credit card. He's the guy who took a public company, ripped the dead cash off its balance sheet, issued debt, sold equity, and turned all of that into Bitcoin at a speed no retail investor can match. And here's the nasty detail. When the price goes up, he looks like a visionary genius. When the price goes down, he looks like a leveraged maniac standing on the edge of a cliff. The market loves that love-hate drama. The problem is that the average person only sees the genius part. They see headlines calling him the Bitcoin king, see conference stages, bright lights, poetic lines about fire in cyberspace, and think, fine, I just need strong conviction. Buy the dip, and the strategy that makes him rich will make me rich too. It won't. At least not if you try to play the same game with amateur tools. Let's be clear about the battlefield you're stepping into. We're talking about Bitcoin in 2025 after a brutal roller coaster, giving back a big chunk of the year's gains, scaring funds, retail, leveraged traders and regulators who thought they had this thing figured out. In the middle of this mess, who keeps buying more, doing public calls, getting on stage and saying Bitcoin is the best asset ever invented by humanity, Michael Saylor. But Saylor plays with pieces you simply don't have. He has a corporation with access to global capital markets, can issue convertible debt, raise billions in a few hours, use stock as currency, and stack all of that on a single thesis. Bitcoin will beat everything else in the long run. You, at best, have a salary, a fragile emergency fund, a retail brokerage account, and a bank that barely trusts you with a credit limit. So notice the paradox. The same move that for him is optimizing a corporate balance sheet around digital capital becomes pure financial suicide if you try to copy it blindly. It's like watching a fighter jet fly upside down and deciding to copy it with a tiny car on a broken road. The physics are the same. Your odds of dying are similar. This video is not here to tell you to worship or hate Saylor. The real goal is different: to unpack the mental model behind his strategy and show you where it makes people wealthy and where it almost destroys them. From here on, we're going to take the 21 ways to wealth he laid out, mix them with Charlie Munger-style brutality, and apply them to your reality as a normal investor. No listed company, no billion in credit, but something Saylor keeps talking about: time and the ability to think. If you stay to the end, you'll understand three things. First, why Bitcoin in his head isn't a currency, it's pure capital. The hardest financial energy you can carry into the future. Second, why courage, focus, and leverage, used the wrong way, turn into a guillotine instead of a shortcut. Third, how you can learn from the strategy that makes Saylor rich without letting it almost destroy you in the next bear market. Let's start with the first pillar Saylor himself chose: clarity. Before he talks about courage, leverage, or corporations, he opens with one simple, brutal idea: Bitcoin is capital. Not a toy, not a lottery token, not just future money to buy coffee. Capital. In his mind, Bitcoin is perfected capital. Programmable, incorruptible, engineered to survive decades of inflation, government mistakes, and financial chaos. Once you see it like that, everything changes. How you buy, how you hold, and especially how you survive the next crash without blowing yourself up. Think about the practical difference. Someone who sees Bitcoin as a lottery ticket wants to get rich by the next halving. They want the story of, I put in a little and it became a fortune to tell at the pub. Someone who sees Bitcoin as capital wants to still be financially alive in 30 or 40 years with a position, with sanity, with room to be wrong and stay in the game. One is chasing shortcuts, the other is building a foundation. Saylor is not trying to flip his balance sheet for a quick win. He is literally swapping cash, bonds, and weak exposure for a form of capital he believes will absorb a huge slice of global financial value over the coming decades. You can argue about the size, but you can't ignore the logic. If that is even partially true, treating Bitcoin like a weekend trade is almost an insult to the asset. This is where most people mess it up. The average investor looks at the same asset and turns it into emotional scratch cards. Buys in euphoria, sells in panic, turns on leverage to speed things up, takes personal loans, stacks risk they can't handle, and calls that courage. That's not courage, that's lack of clarity. Courage is taking risk, knowing exactly what you're doing, with a base, with a plan, with a time horizon. What most people are doing is just anxiety wrapped in a candlestick chart. You don't see serious business owners taking expensive working capital loans to punt on meme coins. But you do see people maxing out credit cards to copy Saylor on an exchange that would happily freeze their account over a typo. Once you decide Bitcoin is capital, it starts competing in your head with other forms of capital: cash, property, stocks, bonds, your own business. The question stops being, will it pump tomorrow? And becomes, over 10, 20, 30 years, which form of capital is most likely to survive money printing, bank failures, and macro chaos? That's what Saylor is really answering when he says Bitcoin was engineered to outperform other assets. It's not just a stage line, it's a decision filter for decades. If your honest answer is still, I don't care, I just want to pump, you're playing a completely different game. Now, notice how clarity changes behavior. If Bitcoin for you is long-term capital, you naturally care less about this week's price and more about how many units you can stack over the years. You stop asking what's the monthly yield and start asking, how much of this can I hold through each crisis without panicking? The focus moves from drama to survival, from the emotion of a green candle to the cold maths of time plus discipline. That's where Saylor's strategy starts to make sense. He's not trying to nail tops and bottoms. He's trying to maximize how much capital in BTC his structure can carry to the other side of history. But there's a detail you can't ignore. Clarity is not just about the asset, it's about you. It's useless to understand that Bitcoin is incorruptible capital if you're easily corrupted by anxiety, greed, and envy. It's pointless to see Bitcoin as a pillar for the century if you treat your own budget as if each month had 80 days. Clarity demands brutal honesty. How much of your income can really become Bitcoin exposure without putting you on a financial tightrope? How much drawdown can you stomach in a bear market without rage selling the bottom and blaming the asset? So if you want to learn anything from the strategy that makes Saylor rich without letting it destroy you, the first step is not courage, not leverage, not buy every dip. The first step is clarity. Clarity about what this thing actually is in your life. Is it part of your long-term capital base or just this month's adrenaline shot? Is it a pillar of your wealth building plan or a fancy excuse to keep gambling and call it long-term vision? Until you answer that with brutal honesty, any Bitcoin strategy you think you have is just self-deception dressed up in a trading app. And once you have that clarity, the other pillars he talks about: conviction, courage, family, companies, credit, stop being weapons pointed at your own foot and start becoming real tools for building wealth. Without clarity, courage turns into recklessness. Without clarity, leverage turns into a time bomb. Without clarity, even a brilliant asset becomes just another way for you to stay the hamster on the wheel, sweating hard on top of something you never really took the time to understand. Now that clarity is on the table, we move to the second pillar, conviction. Not that bull market faith that disappears at the first negative 30%, but conviction built on logic, data, and time. Saylor keeps hammering one point. Bitcoin was engineered to grow faster than traditional forms of capital. Not because it's magic, but because it combines three things almost nothing else does at the same time: hard scarcity, a global network, and protection against dilution. You may not like his style, but the logic is straightforward. If you have an asset no one can print, anyone on the planet can access, and it sits in a system addicted to printing money, what are the odds that in 20 years it does not end up worth a lot more than today? In this context, conviction is not, I believe, because I watched a clip. Conviction is what's left after you fight with your own fears and with the facts. It's what remains when you actually look at official inflation, real world inflation, interest rates, public debt, governments burning money like there's no tomorrow, and you ask the ugly question, where can my capital realistically survive this? If after study, your honest answer is still Bitcoin is one of the few assets that makes sense to hold for decades, then conviction stops being cult-like and becomes a rational outcome. But here's the catch. The market doesn't charge you for clarity in a bull run. It charges you for conviction in a bear. It's easy to shout hodl when the chart only points up and every influencer looks like a genius. It's hard to hold when the same asset is 50% below the top, headlines scream bubble again, and your mate sends you a screenshot saying, told you so. That's when you find out whether you had conviction or just borrowed enthusiasm from other people. This is where Saylor's strategy almost destroys a lot of followers. They see him adding to his position in the middle of chaos and think, if he's buying more, I'll double down too. With no cash, no structure, no emotional buffer. Result: liquidation, forced selling, resentment. Look at the contrast. Saylor can call Bitcoin perfect capital and still sleep through a 60% drawdown because his structure was built to carry that volatility. He has a company, revenue, access to credit, an optimized balance sheet, decades of experience. What do you have? A vulnerable salary, bills, maybe dependents, maybe debt. Conviction is not copying his external posture. It's aligning your exposure to the size of your actual life. For him, conviction means leveraging an entire corporation around Bitcoin. For you, conviction might simply mean not selling the portion you can realistically carry, even when your entire feed screams end of the cycle. So the honest question isn't, do you believe in Bitcoin? It's another one. Do you know how much of your life can depend on this without driving you insane? Saying all in on social media is cute. In practice, healthy conviction has limits, percentages, numbers. Beyond that, it stops being conviction and becomes desperation disguised as courage. Mature conviction accepts that you can be wrong on timing, right on thesis, and still survive. Adolescent conviction thinks it has to prove to the world that it feels no fear. And that's the core of this block. The same conviction that makes Saylor wealthier, if applied the wrong way, almost destroys the average investor. Because you're not just carrying price risk, you're carrying emotional, family, and career risk. Each crash turns into fights at home, sleepless nights, performance dropping at work. The asset is the same, but the system around it is completely different. That's why copying Saylor's tone without copying his base preparation is almost a guarantee you'll be kicked out of the game right when the thesis finally starts to work. Conviction, in the way that matters to you, is not shouting louder than the critics. It's building a position you can carry while the entire world calls you an idiot. And unfortunately, that does not fit in a meme quote or a 50x leverage trade. Clarity and conviction sound beautiful in theory. The real trouble starts when we hit the third pillar, courage. And this is where a lot of people sabotage themselves because they confuse courage with recklessness. Saylor talks about embracing intelligent monetary risk. That is not the same as waking up on a bad day, selling everything you own, taking out a loan, and aping into spot and leverage Bitcoin at the same time. Courage, in his definition, is accepting that to capture an asymmetric opportunity, you have to endure pain, volatility, mockery, and uncertainty, but inside a structure that doesn't kill you on the way. Think about the fire metaphor he uses. Satoshi lit a fire in cyberspace. Some people run away from it, some play with it doing tricks, and a few actually feed it. Who feeds the fire? Those who take capital that would otherwise rot in cash, weak bonds, or overpriced property and reallocate it into Bitcoin with a multi-decade horizon. But notice, he's talking about reallocating capital, not burning his own house down. There's a huge difference between reshaping a balance sheet and torching your income. The average investor often tries to skip the boring part of courage. Instead of starting small, testing their own mind, understanding how they react to a 20%, 30%, 50% drawdown, they go full hero mode. Either I make it huge or I blow up. That's not courage. That's shortcut addiction dressed up as bravery. Real courage looks far more like boring perseverance than like a movie scene. It's continuing to buy when no one is clapping, studying instead of refreshing the price, accepting that you won't have an epic story to tell tomorrow. You're building something for decades from now. Saylor has the courage to say publicly that he's leveraging a public company into Bitcoin because he's consciously accepting being judged for it for years. He knows that if it works spectacularly, people will call him a genius afterwards. If it fails, they'll call him reckless forever. The question for you is, can you handle that kind of judgment at your own scale? Can you stand being the Bitcoin idiot in your family for 5 years until the thesis turns without needing validation in the middle? If the answer is no, your position size is probably bigger than your real courage. In your case, courage might be far less glamorous and far more consistent. It's the courage to say I won't sell in panic, but also the courage to say I won't double my position just because a billionaire's buying. It's the courage to admit that you are not Saylor. You don't have Saylor's company. You don't have Saylor's credit lines. And exactly because of that, you need a different risk plan. There's nothing more cowardly than pretending to copy a giant when, in practice, you're just betting everything on a shot you can't afford to miss. In the end, courage in Bitcoin is not about making the riskiest move. It's about making the move you can still live with when everything goes wrong at the same time. If your courage only exists when the chart looks pretty, that's not courage. That's bull market special effects. There's a point most people ignore when they copy Saylor's speech. He constantly talks about family, teams, generations, cooperation. He literally describes a Bitcoin team inside his own family. Parents with capital and credit, children with time and potential, himself with capability, knowledge, and conviction. In other words, he is not a lone hero. He's an entire ecosystem pushing the same goal over decades. Meanwhile, most investors are playing solo, in secret, trying to perform miracles with whatever is left of their paycheck after putting out fires. Often their partner doesn't even know the real risk being taken. Someone might be allocating 30%, 40%, 50% of their net worth into Bitcoin during a bear market, while at home everyone thinks it's just a little investment in an app. When the crash hits, it's not only the spreadsheet that shakes, it's the marriage, the relationship with the kids, the trust of the family. Cooperation in Saylor's logic solves two problems at once: firepower and time horizon. A grandparent with capital stuck in weak products can help finance the entry of a younger generation into a long-term asset. A younger person with decades ahead can carry this risk much longer than someone close to retirement. But notice, this only works when everyone knows the plan, the risk, and the time frame. It's not about forcing Bitcoin down anyone's throat. It's about aligning the vision of capital across generations. You may not have a dynasty trust, but you can have something simpler and powerful. Transparency with the people who depend on you. Explain why you're building a position, what percentage it represents, what the worst case scenario looks like, what the plan is if things go very right or very wrong. This not only reduces psychological pressure on you, it turns Bitcoin into a family project instead of a secret you carry alone. Heavy financial secrets are exactly the kind of thing that crushes conviction when the market turns. The other form of cooperation is outside the family. Partners, co-founders, team. Saylor is not hitting the buy button alone in a mobile app. There's a board, a finance team, legal advisors, operators. Copying the final risk without copying the process is trying to replicate the result without the foundation. For you, cooperation might mean having at least one person who can challenge your decisions without hype. Someone who pulls you back to reality when you start believing your own narrative too much. In the end, cooperation is accepting that building wealth in Bitcoin is not an ego test, it's a team sport. The more you try to prove you don't need anyone, the more exposed you become to your own mind. Another pillar Saylor leans on is capability. Not high IQ capability, but the ability to use the right tools. He openly says that in 2025, any individual effectively has access to an army of accountants, lawyers, professors, economists, and entrepreneurs condensed into artificial intelligence. And most people simply don't use it. They'd rather ask a mate in a WhatsApp group than ask an AI trained on thousands of pages of information. When he says he first asks everything to AI, argues with it, refines the answer, and only then takes a 95% finished solution to his lawyers, he's saying something most don't want to hear. If you don't use this kind of intellectual leverage, you're playing the game on hard mode. You're trying to navigate Bitcoin, tax, structures, and risk purely on gut feeling and a handful of random opinions. In an asymmetric game where banks, funds, and companies use every tool available, showing up with just vibes and basic Googling isn't humility, it's negligence. Capability in the context of this channel means you are no longer alone against the market. You can ask an AI about the tax impact of selling part of your position, about legal structures available in your jurisdiction, about common mistakes retail investors make in bear markets, about mental models you might be missing. It's not that AI will decide for you, but it slashes the cost of being ignorant. It removes excuses like, this is only for the rich, this is too complex, this is just for institutions. If Saylor, with decades of experience, a full team, lawyers, and millions paid in fees, still starts with AI to structure his thinking, what excuse does the average investor have to keep operating on pure guesswork? Capability today is no longer about which university you went to or what title you hold. It's about whether you have the humility to ask, insist, and refine. Choosing to stay in the dark because it feels more comfortable is choosing consciously to play against yourself. Here's another uncomfortable truth. A lot of people use Bitcoin as an excuse not to study. It's simple. Just buy and hold. It isn't. The idea of buy and hold is simple. The real world execution across cycles, taxes, personal crises, and even moving countries is anything but simple. If you don't increase your capability, if you don't push yourself to understand the details that can knock you out of the game, from leverage to taxation, from security to inheritance, you may be building a castle on sand. Capability is not about becoming an expert in everything. It's about asking the right questions to the right tools at the right time. And that's what will separate the investor who uses Bitcoin as a capital building lever from the one who uses it as a stylish excuse to keep gambling in the dark. Now we get to the part that really hurts for those trying to copy Saylor as a retail investor. Corporations, credit, and capitalization. He casually says that a well-structured company is the most powerful wealth creation machine on earth. Why? Because a corporation can do things an individual cannot. Issue shares, issue debt, raise capital at lower cost, and use its own cash flow as an engine to buy more assets. When Saylor uses strategy as a vehicle, he's plugging Bitcoin into a ladder that already existed. A listed company, access to capital markets, reputation, track record. That ladder is what lets him raise money at single-digit rates and try to capture 20%, 30%, 40% a year on the asset he believes in. He turns the fear of creditors into yield for them and into capital to buy more BTC. That is completely different from taking a high-interest personal loan to buy Bitcoin because you watched a hype clip. Capitalization, in his logic, is a race. Whoever ends the game with more Bitcoin wins. But he's running with industrial fuel tanks, and you're running with a plastic jerry can. The idea of using credit to accelerate accumulation only makes sense when the cost of that credit is clearly below the expected return and when the drawdown along the way doesn't wipe you out. For a company with billions in assets, a 60% drawdown hurts but doesn't necessarily kill. For a family with a thin safety net, it can be fatal. The temptation to copy is huge. If he uses debt to buy Bitcoin, I can too. The question isn't can I, it's can I survive the worst case scenario? If the answer is no, credit isn't intelligent leverage, it's a noose. Saylor talks about the spread between the cost of capital and expected return. Are you honestly willing to measure that in your own life? Or do you just want the adrenaline of feeling like you're accelerating exposure? So what can you bring from his corporate strategy into your retail reality without turning it into suicide? First, the idea of priority. Before thinking about credit, the priority is building your own capital, reserves, and stability. Second, the idea of order. Maybe it makes sense to use a company, a small business entity, some legal structure to separate business cash, personal cash, and Bitcoin investment cash. That doesn't turn you into Saylor, but it does pull you out of the everything in one account chaos. And third, the idea of responsible speed. You don't need to use 100% of your borrowing capacity. You can choose not to use it at all or to use it in a very conservative way. The key is to understand that the game he's playing is different. The lesson is not go into debt to buy Bitcoin. The lesson is if you have a structure that can carry risk, you can capture a huge spread between the world's fear and the asset's asymmetry. Until then, rushing to borrow just to feel brave is asking to become another crash statistic. There's a part of Saylor's talk that feels like a direct jab at half the market. Focus. He openly admits he spent decades trying to do brilliant operational things, products, services, ideas, and found out the hard way that most of them fail. Companies die, trends fade, tech gets old. A well-structured financial bet on a strong asset, on the other hand, tends to outlive your ego. When he says, Don't confuse ambition with accomplishment. He's hitting our modern addiction to being in everything at once. 10 coins, 5 businesses, 3 side hustles, 2 countries, 1 attention split across 50 projects. Focus, for him, is almost an insult to the culture of distraction. For you, it's a reminder there's no point trying to match Saylor's depth of conviction if you're mentally fragmented across 20 different bets. Discipline is exactly what plugs into this. Discipline isn't just not selling at the bottom, it's refusing to chase every new narrative that pops up in your feed. It's not turning Bitcoin as core capital into Bitcoin plus a dozen casino chips around it just in case one does 100x. It's understanding that if your central thesis is strong, you don't need to decorate it with 10 weak theses just to feel clever. Self-sabotage in this game almost always grows out of lack of focus. You start with a clear idea. I'll build a Bitcoin position over years. And along the path, you begin to make exceptions. Just this one leverage trade. Just this altcoin that will move with it. Just this NFT because everyone's talking about it. Exception by exception. When the bear market hits hard, what destroys you isn't Bitcoin. It's all the fragile add-ons you bolted around it. Focus in this context means accepting that being kind of involved in everything usually equals being weak in all directions. The sanest path might be doing what Saylor did in his own head, picking one central axis, Bitcoin as capital, and organizing the rest of your financial life around it with brutal simplicity. It doesn't have to be the only thing in your portfolio, but it has to be a conscious decision, not an ego accessory. Discipline is the glue that keeps that focus together while the world keeps offering shortcuts. Without discipline, clarity becomes empty talk. Conviction becomes posturing. Courage becomes recklessness. And cooperation becomes chaos. With discipline, you can do the most counterintuitive thing of all, keep doing the obvious while every part of you is begging to chase something new. At some point, Saylor touches on a topic every investor hates facing. Everything fails. Every counterparty eventually breaks. Every system degrades. Banks fall. Governments change. Tax rules shift. Companies that look eternal today disappear. He doesn't say this to paralyze you, but to remind you of one thing. Bitcoin might be the most resilient asset in your portfolio, but the rest of your life is not immutable. If you refuse to adapt, the structure around your BTC can knock you out even if the core thesis is right. Adaptation here means adjusting course without betraying the principle. Maybe the country you live in today is hostile to long-term Bitcoin holders. Maybe the legal structure you use is terrible for inheritance, tax, or security. Maybe the people you started this journey with are no longer aligned. Sticking to the exact same configuration just out of pride isn't conviction, it's stubborn stupidity. Evolution is the next step, building on what you already do well instead of trying to reinvent yourself every cycle. If you've already learned how much Bitcoin exposure you can carry without losing your mind, maybe the next move is improving protection, custody, family structure, business use. It's not going from 0 to Saylor 2. It's going from disorganized amateur to structured amateur who actually knows what they're doing. Then comes what he calls advocacy, inspiring others to walk the Bitcoin path, not by shouting, but by example. This is not about becoming a Bitcoin prophet, annoying everyone around you. It's about being a quiet reference, someone who doesn't freak out at tops or bottoms, doesn't promise miracles, doesn't need to humiliate latecomers or those who opted out. When you position yourself like that, something interesting happens. You naturally attract good people into your circle and push away casino players. The big danger is confusing advocacy with a need to feed your ego. If you need everyone to agree with you so that you can keep believing, you don't have conviction, you have a validation problem. Sharing the thesis, teaching, bringing more people into the world of long-term capital thinking is excellent, as long as it doesn't turn into a competition over who nails the price or the date. The goal is to increase the number of people who survive the cycles, not the number of people clapping for you when the chart looks pretty. Let's tie it all together. The title of this video says Bitcoin and Michael Saylor, how the strategy that makes you rich almost destroys you. By now you've seen what's behind that line. Bitcoin as capital, not a lottery. Clarity, so you know which game you're in. Conviction, so you don't get thrown out at the first negative 50%. Courage, so you can stand the fire without jumping into it. Cooperation, so you don't carry this weight alone. Capability, so you use AI and structure in your favor. Corporations, credit and capitalization, so you understand he's playing a different game. Focus, discipline, adaptation and evolution. So you stay alive long enough for the thesis to actually play out. The cruel part is this: the same structure that makes a billionaire with a company, cheap credit, and decades of experience richer can blow up a retail investor who only copies the surface behavior. If you ignore the limits of your own life, income, and mental health, Bitcoin stops being capital and becomes a weapon pointed at your own chest. The problem is not the asset. The problem is trying to live chapter 20 of Saylor's story when you're still on chapter 1 of yours. If you've made it this far, the invitation is not do what he did. The invitation is different. Use the brain he's lending you. Take the mental models and scale them down to your reality. Maybe your version of all in is simply building a sane position, no stupid debt, no suicidal leverage, no promises to anyone but yourself. Maybe your real courage is being able to say, no, that part I cannot copy. Now, 2 practical things. First, if this video helped you see Bitcoin with less fantasy and more honest brutality, hit subscribe on Saylor Bitcoin Teachings and turn on notifications. That's how you tell the algorithm and us. Keep making long-form content, no shortcuts, no fluff. Second, send this video to one person who's trying to copy Saylor without living Saylor's life. That friend flirting with debt to buy Bitcoin, or that person who almost gave up on BTC because they went in without clarity. In the next video, we'll take one of the most sensitive parts of his talk, how to use or not use leverage with Bitcoin without becoming a cautionary tale. Until then, remember one thing: capital doesn't get tired, but you do. So the game isn't just about how much Bitcoin you stack. It's about reaching the end of this race in one piece. If you take care of your structure, time and maths will do the rest.